All right, what's up, everybody? Welcome to Mackey's Retail Roundup Live. I'm Spencer Israel, Stock Market TV. That's Jeff Mackey from Mackey's Retail Roundup. And Jeff, I guess it's a good time to be you because A, retail stocks are going up, and B, we're in earnings season, which means you get all this information and all this commentary from companies that you follow. So
Sure,
you're
sure.
having a pretty good couple weeks, aren't you?
And see, it's a day that ends in Y, Spencer. And I'm not going to lie, it's always a pretty good time to be me. But yeah, we're having this is it's we're at a kind of a little proximal peak here in terms of things kind of rolling the way we want to. We saw consumer sentiment come in today. That's why I wanted to start because we're finally getting economic data, right? As these stocks have been ripping, you and I have talked about it pretty much weekly. Like, is this the stock market just being kind of insane, or is stuff actually going to work out? All the economic indicators, everything that predicts kind of anything about how people feel, what kind of vibes there are, what kind of negativity, has been just straight garbage. Which, I've got the consumer confidence index up here first. You can see the great financial crisis. People weren't that confident then. Go figure. You know why? Because they were losing zillions every day. People open up their basically their brokerage account and they tell you how confident they are. It's so they responded the way they should. The question in May wasn't whether or not they'd be fired up on their brokerage account. It's just whether or not all this kind of endless, still lingering trade war crap was really bringing them down. And it's not. Between the earnings, between now this latest piece of data, I'd rather listen to the earnings than the data. We'll get to that in a couple of minutes. But when it starts to line up this way, you're still looking at stocks. It's the XRT, which we're going to go to. Hold on. There we go. The XRT we're back down to, we're still below the highs. We're 10% off the highs. And so you have stocks that haven't really broken out yet, and an earnings picture that isn't great, but isn't getting terrible. It's our worst case scenario seems to have been avoided through, is there a real method here? I'm not so sure, but we just kind of back off the tariff thing just a little bit every week. That's super bullish. That's so much better than April, when it was like, you know what, we just have an embargo on the rest of the world and we're going to become kind of a local agrarian economy now. It's much more bullish for Gap to have this type of environment. People can do business again and the earnings have come in. So everyone's getting all bulled up. We got the XRT breaking above the 200-day and things look kind of good. The other thing, and then I'll let you talk, earnings are getting bought. Bad earnings getting bought, man. You pile it up, and so if bad earnings getting bought, the fundamentals are getting better, and the stocks are still 10% off pretty recent highs. It's hard to be that bearish. I don't know if it's a screaming buy, but it seems wrong to be leaning into this week of earnings just super negative.
Yeah, that's a great point. We talk about that all the time. You obviously care about what the earnings are and what the company says and the financials and the balance sheets. But even if you ignore all of that stuff and you look at the reaction to the reports, that can tell you in a lot of ways all you need to know, right? So these are all companies here: Williams-Sonoma, AutoZone, Target, American Eagle. All four had quote unquote disappointing earnings, in the sense that I guess they came in below estimates. But as you note, Jeff, all the stocks are basically higher or
They're finding a bid, right? I
right.
mean, it's and I put these together specifically because they really were all over the map. I mean, Target seems to be aggressively just driving into the ditch. Don't get me started. I swear, don't get me started. American Eagle, they're just kind of like, in the, we're all just fortune's victims, And Williams-Sonoma is an excellent operator in a tough environment. And it's AutoZone kind of just came in a little bit light with results
Yeah.
that probably would have been sold in an aggressive way 3 months ago. Kind of a meh reaction today. And so in all those cases, we could have taken them down. There's a certain amount
And
of
they
art to
did
this.
take it. They took them all down for a little while, but the right hand of this chart shows that pretty much at least all four of these stocks have been bought off of those earnings dips, which
Right.
is very, very bullish behavior.
Well, you can trade them however you want. You can get an entry point if that's what you're looking for. You can play it a lot of different ways. I'm not here to micromanage people's books. I'm here to give them the playbook, basically, in terms of what the firmament out there is saying. And if you would have bought Williams-Sonoma down 10%, you're making money. You would have bought Target, which was, again, the worst quarter I've heard so far. They've made you money. If you can buy these losers coming off, quarters that otherwise are disappointing, that's super good. So, here's the bull case. Basically the vibe kind of tariff. We don't really have any announcements yet. It turns out that when I had my three wishes, where I was hoping that things would be written down and that kind of both countries would agree to this as opposed to just, social media. We were shooting too high. We've lowered our expectations now. We're just kind of the EU saying, we'll just extend this a little bit. Holy crap, we can extend stuff forever, Spencer. I'll let you know a little secret in this country. Social Security, it's been going bankrupt since before you were born. I was there for the conversation. Like, we're always screwed. We'll delay things forever. This country loves a delay. So if we can just put China on hold, we put the EU on hold, it's like this stuff really never happened. And that's kind of what the retailers, as far as I'm concerned, I was just worried about empty shelves a couple months ago. That's not happening. And so, the sentiment and price debates, that's being settled in favor of the price. The sentiment's coming back, as long as people stay employed and the docks are back in business, everyone's back in business for now. But you know what? If they delayed before, we think they'll delay it again. The buyouts, Dick's, Foot Locker, we'll get to them in a second. That puts a floor in some of these stocks. And just, really, it has to be said, the companies are so much better now than they were during COVID, Spencer. I mean, it's because this was a really similar shock. This was really just what if we just kind of randomly shut down countries? A 245% tariff on China is like saying the factories are all closed. 5 years ago, that destroyed so many companies. And now people flex, they figured it out. And that's been the overall kind of takeaway in the calls. They've kind of waffled a little bit on whether or not to raise prices, but every company that I've listened to anyway has proved at least a little bit, and in some cases quite a bit, over the way they managed these type of things 5 years ago. And
that's a really good point.
Been pretty good.
That's a really good point. That a lot of companies, were destroyed, right, when global supply chains froze, and they've learned their lesson in the ensuing 5 years, and so they can pivot more quickly, which is exactly what they've done. So that's the bull case. The bull case is companies are nimble and quick when it comes to their supply chains. You've got M&A things swirling, animal spirits, right?
Yep,
People are excited. You've got prices going up. And, the general vibes around tariffs has been the worst case scenario has been averted. But that's the bull case. What's the bear case here, Jeff?
The bear case is alas, pretty simple, which makes it pretty compelling. The earnings are still coming down. And it's really hard to buy just kind of negative earnings. We'll talk about a specific case coming up, but it's going to take a hit. Operations are definitely taking a hit for at least kind of the next couple quarters. And so we'll see how well the company is going to execute, but the fundamentals are getting worse. That makes the market look more expensive. That's bad. And there's a certain fragility to it when, it's whatever.media.com, all of a sudden just these social media messages come across and no one's really used to that yet. We're still a little fragile with it. So, who knows? I mean, he could watch Rocky IV and decide that the Russians suck and tweet out something nasty. And all of a sudden we're down 500 points in like 5 seconds. That's literally a thing that could happen. We're trying to get accustomed to it as a nation of investors, but it's a new world and it's not necessarily for the more profitable. So really you just have an argument that things are getting worse, fundamentally, but if they find a balance point, we're still America, damn it.
All right, let's look ahead. We've got a few companies in your sphere of influence reporting earnings later on this week. We'll start with Costco. This is full disclosure, my favorite retail stock. It's one that I've owned in my long-term portfolio. I will continue to own it. I'm a member. I shop there probably twice a month, which is too much for a household of two, soon to be three. But in any case, I like it a lot. Give us your take on the stock now. And then what do you expect them to say on Thursday?
Yeah, you and I could be in a club, and I think they could start one of people who are trapped long Costco. It's amazing, right? I mean, it's a fantastic company. It's great. It's so expensive. It is just kind of bonkers. We talk a lot about the big three in retail, and I've put two of them on this chart because Amazon's so techie that it kind of doesn't really get counted much. But Costco, Walmart, and Amazon are really just taking over all of discretionary retail and kind of almost any environment, but particularly when you stress the system the way we have for the last month or two, that accelerates the process. And so Costco is just the beneficiary of that. I mean, the membership dues that they're able to charge, the people, the passion they're able to get, it's just money in the bank every quarter, quarter after quarter, and that gives them resources that Target just can't touch. And as a result, you have a stock that's up 260% in 3 years or 5 years. So that's pretty good. That's outrunning all the competition. But what the real thing that I want to hear from them tomorrow, they've had great same store sales that they release monthly, which is fantastic. A certain folksy charm. I want to hear what the traffic looks like. And I would expect at this point, the bar's been raised such that Costco should really say that they're not going to have a problem with this kind of the trade war at all. They buy opportunistically, meaning like they don't have to have 40% in health and beauty like the way Target would. They don't have that kind of space allocated. They're opportunistic. It's a great model, great company, super expensive stock. I'm with you, man. It would be really hard to get me to sell them. Just because of the tax hit and the love for the company, but it's their day will come, but it won't be tomorrow.
Let's not forget September 1st, right? Costco raised their membership prices for the first time in 7 years. So they always have that in their back pocket should they need it, right?
And you know what happened? More people signed up than ever before. So people love their Costco, man. They love their Costco.
I mean, what am I going to do? Not go? Of course not. Come on.
You could go to the new Foot Locker, Dick's merger.
Let's go there next. Dick's Sporting Goods.
Go there next.
They report on Wednesday, right?
Yep.
Yep. And really, you have questions about Foot Locker because they just bought Foot Locker for $2 billion.
Yeah, and it's a big acquisition. It's not that huge, 10% of the company for Dick's. And the questions I would have are, is this the best idea to have for growth? I mean, is this really kind of it? In which case, Dick's is a low multiple company, but sporting goods is not exactly a fast growth thing. People, we're going to be sporting at about the same percentage the population grows, give or take. A huge amount of exposure to China. That may or may not matter, but in terms of just their capital allocation, Dick's has run out of place to put the big, huge superstores. They're great at it. They dominate the market. They do a huge amount of business, but do they really need to be deeper in shoes right now? And they didn't have great answers for that. I think it was because maybe my friend Scoop Thomas over there at the Wall Street Journal kind of announced this on behalf of the companies involved a little before they wanted it to. And so Dick's, as a result, immediately said, hey, don't be opposed to this merger. We're friendly. We're here to just get the best out of everyone who's working here. We love you all. That's not going to cut it for Wall Street. We're going to have to get adult tomorrow in the conference call and really talk about where we can kind of gut out some of that Foot Locker inefficiency. So that's a big deal in a tiny space. And also we saw the American sport, the Dick's competitor, the kind of tick on the butt of the elephant that is Dick's Sporting Goods, reported actually, and the stock just went crazy. Dick's has been beaten up pretty bad. The chart doesn't look great. Been on one of the all-time heaters over the last 4 or 5 years. Love management, but they've got some splaining to do because, buying Foot Locker just because it's cheap, we'll see how that goes. And finally, Macy's. I don't know. I don't even know if it's still relevant. Have you been to Macy's, Spencer? You're a young person.
I was in a Macy's 2 weeks ago, actually. I was looking for pillows, so I was in a Macy's for that. Prior to that, I had not been. I couldn't even tell you the last time I was in a Macy's. But this is one of the all-time wall. If you just zoom all the way out on this thing, Macy's is trading today at the same price it was at in 1993. So right. This is just an all-timer.
And let me tell you something about 1993.
Wasted capital.
They were coming out of a bankruptcy at which a young man named Jeff Macke was part of that as a junior hiree. My first job out of school, I worked at Macy's when they went bankrupt in 91, 92. Nice. And so they came out of that and have been dead money since because, probably not because I left, but I did in fact leave during the bankruptcy. This is not a great company. They're super kind of levered up. It's really an office-based company. Now, what's interesting about them, though, is we mentioned Foot Locker and Dick's. Now, if Foot Locker can get bought, because that was just a steaming dumpster fire. I mean, it was just pure kindling. pure gassed up, just Nike footwear that they couldn't mark down, dumpstered and ready to be lit on fire. And Dick's came in and saved him. Macy's has been turning down deals for years. And so both Macy's and Kohl's, who have been guilty of this in the past, Macy's had bidders over 20, and they said that they didn't think the financing was sufficient. The answer to which, of course, is, who the hell are you to talk, Macy's, to be honest? But, it makes sense for a private equity group because they got the Blue Mercury. They've got a couple things that are working, but that's not the department store. And so the idea here is that you just make office space out of the stuff up above and kind of do some apart on what the retail's got going on. But they've turned down a deal. Now, when they report tomorrow at $11 a share, it's really cheap. It's super cheap for a reason. But if we can see some buyout energy start happening on these really cheap for a reason retailers, it would do two things. One, it would say good things about kind of the real economic outlook out there, because they haven't been able to get this deal done for 10 years and it's been screamingly obvious they need it. And two, it puts an absolute bid under just a lot of really bad stocks. We're going to, some of whom we're going to hear. Again, Kohl's is reporting tomorrow. It's holy cow, do they have problems? They hired the best CEO they've had in probably 5 years, and they had to fire the guy in 3 months because he was using vendors that his girlfriend apparently sponsored, coming to Netflix next quarter in a docudrama that Kohl's won't get one penny for. So, it's a bad company, but, it's, again, if Foot Locker can get bought, man, there's hope for anyone. So let's see if the investment bankers out there can do their job and get some of these deals done.
Macy's all-time high, $70 in 2000, and actually 10 years ago, almost exactly 10 years ago. It'll be 10 years in, I think, in July or August. So
you've got some space there. You're not going to see those sellers coming out at all-time highs. Those people have been waiting to sell at $70. Probably, you have your time. You can get a 7-bagger before it actually happens.
All right, so we kind of ran the gamut here. The three reports: Costco, a stock and a chart that Jeff loves; Dick's Sporting Goods, a company and a chart that Jeff is not sure about. Maybe we've got to wait and see what they say. And then Macy's, which is pure dumpster fire. So,
but Macy's is ironically, if I was going to take a flyer on it would be a Macy's long shot
because of a potential buyout.
Just right? Because we are entertaining offers. That's all it would take. Honestly, if the board of directors wanted to do the first thing that would be remotely smart and not potentially litigious expiring, it would be that they would just say, you know what? Maybe we should have hit the bid at 24. We're going to revisit the idea of perhaps pursuing strategic options since we can't really have any idea what we're going to earn. That gets the stock to 15 easy. Will that happen? Probably not, but that's why it's a lotto ticket rather than an actual investment, because you don't want to. I don't hate that. I
don't hate that. All right.
Yeah.
A lot going on here in Macke's world. If you want to get Jeff's free research, there are free emails. There was a link in the description below. If you want to get Jeff's actual trades, find out what is in his portfolio, what he's buying, what he's selling, what he's holding, what he wants to buy if certain things happen, join Macke's Retail Roundup. The link to that is also in this description on YouTube. Jeff puts out his portfolio update every single week, and you can see what's in it. So that's what we got, Jeff. I'll see you in that video on Thursday you're doing for your members, and we'll have to wait and see what comes out this week, what you like, what you don't like, and you'll have to just send us some emails and tell us what you think.
Hey, there's huge trades out there, baby. Go get them. Go get them. Let's make some money and come back next week.
See you guys.